Today's video focuses on exchange rate. In Europe, a wide number of households borrowed in Swiss francs, which is a currency other than the local currency, other than their own currency, the currency that they're getting paid by their jobs, the currency that is put in circulation by their governments. And they were told so. They were missold these kinds of loans by banks who wanted to profit at the backs of those clients by pushing them, by using them to take the loans so they can make a profit by, based on the interest rates. On the interest rate, basically, that we're going to be charging on the money that we're going to be loaning to them, and lure them into making those loans, but failed to tell them that there was a catch, and the catch was that yes, they would be paying a lower interest rate. However, such as interest rates are prone to volatility, so exchange rates basically are too. So if they fail to tell them, or they didn't at least explain to them well, to the point that they would understand, realize that the loans, the cost of the borrowing could like triple and double up in value. That basically, if the Swiss franc, the foreign currency that we're borrowing in, so they can take advantage of the cheap interest rate, would increase in value against the euro, then they would have to pay more euros in order to cover up for that difference. And I'll set on an example so you will understand better. Let's say that a borrower wanted, that the bank has been launching a year-long campaign about the positive effects of borrowing in Swiss francs, and it convinces the borrower to borrow money in order to buy land. The bank asks the borrower how much it wants, and the borrower says that land costs €1. So the bank loans him one euro, and denominates his €1 basically. It loans him basically, the equivalent amount of €1, the equivalent value of €1 in Swiss francs. So now we're basically on ground zero, right? The borrower owes to the bank 1.70 francs because €1 equals 1.70 francs at the current rate that he borrows the francs. I don't want you all to confuse the fact that the euro is more expensive than the franc. Here the borrower has borrowed francs, right? So he is left with he has to find whatever money that he can get his hands on, pay this amount of money. Yes, somebody come forward and say, hey, you know what? It's more expensive. Yeah, it would have been. It's more expensive. The euro is more expensive. I can buy more francs. Well, that would have been the case if you were buying francs, and then you could have been purchasing goods in Switzerland. Let's say, for example, that with €1 you could buy 1.70 francs, and a good that costed one euro in the state wherever you were coming from, and basically 1 franc in Switzerland, you could be buying basically that good for a lot less. If you divide, for example, if you divide, for example, that 1 franc in the 1 franc by 1.70, which is the purchasing power of the euro. But that does not. That's not really the case in this example right here. You have borrowed in francs, and no matter what it is, you have to, no matter what the value of the of the euro against the franc, even if it's more expensive. Don't forget that the francs are more in number. It's 1.7, right? So you're gonna have to it's not basically 1 franc that you borrowed, so you're gonna have to pay the you're gonna have to pay this 1.77 francs by paying the equivalent amount of euros. 1.70 francs you borrowed. Or you can either pay in francs, which is difficult. You can't get your hands on francs anywhere. You're gonna have to buy francs. You're gonna have to convert euros into francs. Getting paid in francs by your job. So since it's not your local currency, so let's say that overnight that there are extreme conditions in the exchange rate occur. That caused the rise of the Swiss franc against the euro, and there's a rise in value. And now let's say that 1 euro costs 1.2 francs, whereas before it cost 1.70. So you can imagine now that you have to find either francs to pay off the loan, or that you have to find you have to find 1 euro, which is basically the equivalent value of the francs that you borrowed in your local currency. Not only 1 euro, but you're gonna have to find 1 euro and some more money, some more basically euros, in order to make up for the difference in the appreciation of the franc, because your euro has remained stable. The franc has gone up in value, so you're gonna have to make up for that differential. Now if you divide 1.70 francs to 1.2, which is basically the rate of 1 euro to a franc, then there's going to be a differential there. If you divide 1.70 by 1.2, there's going to be a differential which you're going to have to pay, because if you pay 1 euro, you will only, now it has only a purchasing power of 1.2 francs, so there's another 50 cents that need to be covered there, and you need to pay more euros in order to cover that differential. So you're paying exactly the same amount of euros plus the value of that difference in the exchange rate of your inflated now debt in basically euros, right? You have to do that. So you pay exact same amount, plus you have to pay more euros to cover that up. And if you put that in real numbers, the cost of your debt will double up, right? And if the bank will foreclose on your property, it can even triple. It can be tripled, which means it's non-viable. Even if forecloses on your property, right, it might wipe out the value of the land. And since it's going to be tripled in value, it needs its francs back, the bank, you might not even be left with any surplus value of the land. This is going to be that bad. You could have been left with some surplus if the interest rate was not that bad, was not that big. Now that your loan has actually tripled in value, if it forecloses on your land, or if it sells your land, there's a surplus value, there's some equity, still a huge chunk. There's a danger that there's a risk that a huge chunk of that equity will all go towards the payment of the loan of the francs. So in reality, you will have worked and paid for nothing really. The only thing you might have gained is like some interest rate, some low interest rate, which again is it's outweighed by the surge in the exchange rate. So I wanted to stress this. I want to stress this danger, so you know, for all of you that don't know what Forex is, foreign exchange, be careful when you make loans of this kinds, or when you engage in transactions that relate to foreign exchange, because it can have a lifelong impact on your financing, at least. If you like this video, subscribe to my channel. This is just general information, right? It's not advice in any sense, and there will be more videos coming up soon. See ya.